All right. Good morning, everybody. I'm going to get us kicked off. As you can tell, my voice has not gotten any better since last Wednesday, and last night, the combination of a doubleheader basketball game didn't help matters. So those of you who know I attend basketball games will recognize the fact that I get a little animated. Sometimes kind of embarrassing me so. So if you don't want to acknowledge that I'm there, that's fine. We had a very good outcome on the men's game last night. The men's basketball team, by the way, in case you're not aware, is headed off to Alaska here shortly. They clinched number 3 in the conference, and they're going to be going to the conference championships in Anchorage. And then potentially, if they continue to show well, they'll be headed off to Western Oregon for regionals. So you have not only Mikkel Smith getting his second national championship ring last night, but again, men's basketball doing a phenomenal job as well. I wanted to let you know there's two housekeeping things that I wanted to cover before I start powering through bonds, more bond stuff. The first one is I've now had 3 of you not be able to find my office, and so I wanted to give maybe a little bit more explicit directions. I'm in 206 Old Main. But 206 Old Main, it's not like the Harry Potter closet, but it's not a normal office. If you come up the main staircase, the big giant outdoor grand staircase, and you go in the front door of Old Main, there's a little staircase up to the front door, and then there's the 2 turrets that are on the front of Old Main. I live in the turret on the right, and the basement lives in the turret on the left. So if you come up the staircase, you come up the grand staircase, you come up the little staircase. If you get into the hallway, you've gone too far. You'll see a door off that staircase just inside the building. There's a door to the right, the door to the left, and the door to the right in 206. So for the couple of you who have gotten lost, I apologize for not giving more explicit directions because you can't find 206 if you're walking the main hallways in Old Main. There's no wayfaring sign to show you where I live. The second thing that I've done at the request of one of your classmates is I've opened the midterm early. So the midterm was originally scheduled to be open on the 4th of March and is due a couple weeks later. I've opened the midterm effective right now. So 2 shots, unlimited shots like you get on your quizzes. You get 2 shots at the midterm. It's open now. So if you want to start whittling away, it's on chapters 1 through 8. If you want to start whittling away on it, where you have some perverse desire or family requirement to get it done prior to the due date, you can go ahead and get working on that today.
How many questions are there?
75.
Unlimited time.
Say again.
Unlimited time.
Unlimited time. Open books, open notes, open everything, and of course it's due, in a couple weeks. It's due in like 3 weeks. So yes, you're not going to want unlimited chances at it because it's that long.
Is it open and structured?
Is it open? No, I'm not going to answer. I'm not going to answer your questions. I'll answer questions. I'm not going to do the questions. Any other housekeeping things? Any other questions that I can answer before we start powering through bonds? I did put bonds and stocks together, and I'm realizing now that I might have been a little bit ambitious in how much we can cover. Questions?
Yeah. Video of the Wednesday, the link is here, but it's your
YouTube channel. Yeah. So Yes, we're going.
So the petition is not gonna sit down and do all sorts of that question at once. You can like reopen stuff without.
Just like the quizzes.
Okay, so hold on, so you're not-
Correct. It's just like the quizzes. Yeah, because otherwise, if it wasn't, it's like blackout 4 hours.
Yeah,
Not that that's a bad answer, but okay, I'm going to do the best I can to try and get through this class with my voice. If I can't, you know, God bless you all. But like I said, we've got a ton of stuff to cover, and I probably got a little overzealous on what I thought we could cover anyway. Last class we covered bonds in some level of detail, the types of bonds. I want to continue with the definitions. And again, a lot of what we're doing in this part of the class isn't just the math. It's really trying to give you some of the framework and definitions that you need to be able to understand the terminology when we talk it or when you hear it outside the classroom. So debenture, you'll hear or see often companies issuing debentures. Subordinated debenture is kind of the second one. A debenture is essentially an unsecured bond. So where we talked the last time of a mortgage bond and it was secured by property or equipment, a debenture is not secured at all. It's a general obligation of the company. When you've got a subordinated debenture is unsecured and it's subordinate to something else. So you can have a senior subordinated debenture, a subordinated debenture, a junior subordinated debenture, and they essentially stack up. And as we talked last class, when a company liquidates, the creditors have a claim on cash until they're paid in full. And it kind of starts in this concept of a waterfall, where the person at the top of the waterfall, and that may be employees for wages in the case of a bankruptcy, they get paid first. And until they're paid in full, the next person down the board doesn't get paid. And so once you get to subordinated debenture, you're getting down that priority list from, you know, employees, secured mortgage holders, senior debt holders, and then debenture holders, subordinated debenture, junior subordinated debenture. It's important when you're investing in bonds, particularly if you're investing in bonds of companies that may be a little bit troubled, that you understand where you're at in that waterfall, where you're at on that pecking order in the event of liquidation. An income bond, and this says types of corporate bonds, but this also applies to general obligation bonds or other bonds issued by municipalities. An income bond is a bond that only pays interest if the firm earns enough income or only pays interest off of the income in the event that it's an income bond related to something like tolls. So if a municipality builds a bridge, they may pledge the toll income from the bridge to support the bond payments. And anybody here live up in or from King County, Snohomish County? Okay, you know that beautiful 405 with the express toll lanes, right? And everybody's like, this is horrible. These express toll lanes are awful. You can't get rid of the express toll lanes because all the proceeds from the express toll lanes have been pledged to bonds. And they essentially said, okay, we're going to take the expected future cash flow from these express toll lanes. We're going to bundle up as a bond, and we're going to have investors invest in, essentially give us money, Department of Transportation money. And so as a result, they can't get rid of the express toll lanes, which are kind of a bank to my existence, because the proceeds or the cash from the express toll lanes were even pledged to backstop bonds that have been issued by the Department of Transportation. So income bonds aren't just for businesses. They're used more and more frequently by municipalities that are backed by tolls or use fees that you are used to pay off the bonds. A puttable bond is a bond that can be redeemed at the bondholder's option. So the bondholder is the investor. St. Martin's has puttable bonds. So we issue bonds that mature in 2032. And so, you know, in theory, they go out there for a long time, 20 years. However, the bonds have a put provision, which says U.S. Bank, who's the current bondholder, can put the bonds back to us, can make us refinance the bonds in April of 2019. It's not our choice, the university's choice. It's the creditor's choice. And so as a result, when you've got a puttable bond, we talked a little bit last about the bullet, right? You've got this bond that you pay interest only, and then at the end you've got to refinance the balance, you've got to pay it off. A puttable bond essentially says you not only have a maturity date, but you may also have an intermediate put date, in which case you're going to need to refinance the bond, or you're going to have to pay the bond off early at the discretion of, or the option of, the investor. These things make the bonds more attractive to investors because it gives them an option to get out. It makes it a little bit riskier for the issuer, for in our case, the university, because I now have to prepare for 2 refinance dates, April 2019 or April 2022 or 2032. And so I'm working now, as a matter of fact, on trying to find folks who might be interested in refinancing those bonds a year from now, so that way, in the event U.S. Bank says we're going to put the bonds to you, I go, okay, that's fine. I'm going to refinance them with KeyBank. Any questions on a put? Remember, a put is not at the borrower's discretion; it's at the lender's discretion, and it can be somewhat disruptive to your financial planning. Index bonds, the interest payments are indexed to inflation. Floating rate bonds, the rate floats or changes, index rate changes. So in this particular case, you've got an index rate which might be LIBOR, the London Interbank Offering Rate. That's a pretty typical one, or prime. So you hear a U.S. prime rate or a bank's prime rate. These floating rate bonds will shift over time. And so as a result, when interest rates rise, the bond's interest rate rises. When interest rates fall, the bond interest rate falls, and it depends on what the index is. One of the things that you could do as a corporate finance person is floating rate bonds obviously create some risk, right? Because how many of you guys would want to have a car loan where the payment changes every month depending on what the interest rate is? Or a mortgage loan that changes every month depending on what the interest rates are? They do, and they're not pretty. What ends up happening for most of us, and businesses are no different. Remember, businesses are really just groups of people. Most of us budget out. We go, oh, our mortgage or our car loan's $500 a month. If interest rates rise, we all of a sudden don't go, well, now the car loan's $550 a month, and then the next month it's $565 a month, and the next month it might be $1,000 a month because you saw a spike in interest rates. We tend to like fixed rate. Investors tend to like floating rate because that way, as interest rates rise or fall, the income that they're getting rises or falls with it. And there's things called swap derivatives, which we're not going to get into in this class in any extended amount of discussion, where you can essentially take a floating rate bond and turn it into a fixed bond by overlaying a derivative security on it. For those of you who remember the 2008 financial crisis, which was the most recent big deal, you'll hear a lot of talk about derivatives blew up the market. Derivatives have a real value in that they can hedge risk. Where derivatives are misused and are used for speculation tends to be where they cause financial problems. So floating rate bonds will tie to some index, but in general, you're going to prefer a fixed rate bond if you can get it. We talked about zero coupon bonds, which are bonds that don't pay interest payments. So if I were to issue a 30-year bond and it was a zero coupon bond and it was $1,000 par value or $1,000 face value, that might issue for $600 today. You'll get no cash between today and 10 years from now when that bond pays off. But when that bond pays off, you're going to get $1,000. So the interest, instead of being paid periodically, is paid all at the end. Why would a company want to do that? That's exactly right. So companies go, hey, cash is our lifeblood. And here in finance, we're focused on cash. And so if we say, hey, look, we would rather not be paying interest every month or not be paying interest every quarter, rather we want to retain any cash that we generate in our business. Might be because we're fast growing. Might be because at this stage in our business's life cycle, we don't generate a lot of cash. we're maybe a pharmaceutical company, and so we've issued bonds, and right now we're looking to use the proceeds of those bonds to do development of a new cancer drug. It's going to take us 4 or 5 years to develop that cancer drug and go through clinical trials, and then once those clinical trials pass successfully, we're going to be rolling in cash. But in the meantime, for the first 5 or 6 years, we're going to be burning cash. So we don't have cash to pay interest. So instead, we're going to go, okay, we're going to issue 0 coupon bonds we generate in the business, and then at which time, we get out 10 years, our drug is a mild success, we're going to be able to then pay off these bonds. So it's really a way to design debt security so that you don't have to continue to make payments every month or every quarter. Junk bonds are some of my favorite things because they tend to be, it's called, they call them junk bonds, and that's probably a misnomer. They're high yield, high risk bonds that are used to finance mergers, acquisitions, leveraged buyouts, troubled companies. And when you think about why they're junk, it's because they go, oh, well, these are driven by investment grade. So we're looking at something that's an IBM bond. So that's got, we like IBM, it's going to pay that. A high yield bond, the risk is reflected in the yield, right? So you guys, we've talked about, any financial asset is a combination of the expected future cash flows discounted at an interest rate. That interest rate reflects the risk. In this particular case, it's going, hey, these are riskier than normal, so the interest rate's going to be higher. Who gets paid on a junk bond when you've got senior, you've got junk bonds, and you've got the stockholders? The junk bonds get paid beforehand, the stockholders do. So as a result, you're in a little bit better position if you're an equity holder, if you're the person who owns the business or you own the stock, and it may be a really good investment. In a lot of cases, these junk bonds historically have returned a higher rate of return. The risk premium has been too high on the junk bonds, and as a result, they've actually proven to be an investment that returns a little bit beyond the amount of risk that you're taking. So I don't like the term junk bonds because it makes them sound like they're garbage. Really not. They're a legitimate investment tool. They're high yield, high risk, but that's in comparison to any other debt security. They're still lower risk than equity. I'm going to touch on the bond indenture, and this is really a document that says how the bond's going to be managed. And so you've got a trustee who's appointed by the bondholders and says, okay, I'm going to overlook or overwatch the behavior of the company or the behavior of the municipality and ensure that they're in compliance with all their covenants. So within this indenture, it's going to be things like the company needs to earn 125 times the amount in cash, the amount that it needs to pay out on a bond. So if it needs to pay out $100,000 in cash on the bonds every year, there's going to be a covenant in the indenture that says they've got to make at least $125,000. And if they don't, they're in technical default. And so you're going to have a trustee who's going to look at that and make sure that for all the various bondholders that they're actually in compliance with their covenants. And if they're not, one of two things can happen. Either the trustee can issue a covenant waiver and say, okay, here instead of 125,000, you're at 122,000, close enough. We're going to issue you a covenant waiver and say we're not going to do anything bad. Or the trustee can go, you're in default, technical default on your bonds. You violated the indenture, which is our contract around not only, you borrow money from me, I got to pay you back, but also how you're going to operate your business. And they can step in and force a bankruptcy, force a liquidation, or potentially an accelerated repayment on those bonds. And so again, the indenture is the document that really governs how the bonds are going to be managed during the course of the time that they're outstanding. And the appointed trustee is the person who makes sure that the company's doing what it says it's going to do. We talked about a put provision, which was what? Yeah, so in a put provision, the bondholder, the investor, can force you to pay off the bond. A call provision is the opposite of that. So a call provision says, if we have a call provision on university bonds, it gives the issuer, the university, the right to go, you need to give us back our bonds, and we're gonna pay them off now. We're gonna pay them off early. And normally, the call provision has a call premium built into it. So where you've got $1,000 bond, if it's got a call provision, they say, we're gonna call the bond, we can exercise our call provision at 102, which would be, we have to pay $1,000, $1,020 to get our $1,000 bond back. Why do you think a company would agree to paying a little bit more on that bond to be able to have a call provision? Interest rates changed. So here's what ends up happening. If you think about it, it's, got this refunding bullet down here. Let's say interest rates rise, or excuse me, let's say interest rates were, and a bond was issued at 8%. Interest rates now fall to 3% for that same bond issue. If you don't have a call provision, your investors are going to love that, right? Because they're going to be sitting out there going, I've got bonds that are out there and they're paying 8%, the market rate's 3%. What's going to happen to the price of those bonds? The price is going to go up. And we're going to look at how those are calculated. But essentially, when interest rates fall, bond prices rise. When interest rates rise, bond prices fall. And so the company goes, hey, I can borrow that same money at 3% now, I want to refinance. The investors go, I don't want you to refinance. I like the fact that I'm getting an above market rate on these bonds. And so a call provision can get built into the bond at the time at which it's issued, which says the company reserves the right to call these bonds back, but it's going to pay a premium to do it. So instead of just giving you $1,000 and it's going to pay back, they may have to pay back $1,050, and maybe a 5% premium. And so the call provision will tend to, again, when you've got a put provision, it tends to give you a better interest rate. When you've got a call provision, it tends to give you a worse interest rate, because this is risk to the person who's lending the money. There's a risk that if interest rates change, they're going to get their money back early, and they're going to have to put it to work, and interest rates are going to be lower. So there's a maturity risk premium and a liquidity risk premium that they're going to be unable to manage for the call provision. So it's going to impact the interest rate. A sinking fund is essentially a provision whereby the company sets money aside every year to pay back the eventual maturity of the bond. And so there's two different ways. There's actually, it says one of two, there's really one of three. The first one is you've got a sinking fund where the business puts money aside. It's got a $30 million outstanding. It's a 30-year bond issue. They have to put $1 million aside every year. One of three things can happen with that $1 million that they set aside. First one is it goes into a little savings account, and it builds up over 30 years. And then at the end of that 30-year point, you got $30 million and you pay off the bond. The second is you could go out and say, okay, the bonds are publicly traded. I'm going to go out, I'm going to spend that $1 million every year, buy bonds on the open market and retire. And then the third one is you could say, okay, I'm going to have a call provision, and I'm going to call a percentage of those equal to $1 million over the 30 years. And so at the end, I've got a relatively small amount outstanding that I've got a bullet for. Why do you think a company or a lender would want to have a sinking fund provision in a bond indenture?
Secure.
Explain more.
So, like we went over with that whole, when you were going over inflation, you don't want depending on the company or the industry, you don't want the ebbs and flows of political discourse to affect your ability to have some sense of security. So you don't know when the next market crash is going to happen, or when NAFTA renegotiations blow up in everyone's face. Right? You want some, you don't want to be in that situation.
Who else wants to, that's a good answer. Who else wants to expound on that? It all comes down to security. When you think about a bond, if it's a 30-year bond and you said I own 30, it's a 30-year bond and I have $30 million. A sinking fund, you're basically making a bet that in 30 years, you're going to be able to either refinance or pay off that $30 million bond. With a sinking fund, you're going, okay, every year, a little bit of that is going away. And if the company can't make a sinking fund payment, now it's in default, and you know it ahead of time. You're not waiting 30 years for your money. You're able to essentially accelerate the repayment on that bond is normally what will happen if you have a default. And you're going to be able to force a company into bankruptcy and liquidation and potentially get your money back or negotiate out new terms. Convertible bonds are things that you tend to see with companies that are small and rapidly growing. And what it does is it essentially allows a bondholder to convert their bond into equity. So if you think back about how companies are structured, and we're going to spend quite a bit more time on this as the semester goes on, a bondholder is going to get a fixed rate of return. Let's call it 5%. So the bondholder is going to get its 5% every year, and then it's going to get its money back. If you got a company that's really rapidly growing, all that benefit, the bondholders put in, $1 million into this company. The equity holders have very little in, and the bondholders and the equity holders are going, okay, this company's going to the moon. It's like the next company of Amazon or Apple or something along those lines. The bondholders who really finance the entire growth get nothing but their 5%. And if the company liquidates, they get the liquidation preference, but the company's not going to liquidate because the company is doing really well. So when you've got some of these high risk, high return type opportunities, a lot of times there'll be a convertible feature built into the bond. The reason the company will agree to this is because with a convertible feature, they can go, okay, it's a convertible bond, instead of paying 12% interest, we're only going to have to pay 4 or 5% because what you've done is given an opportunity for compensation, other compensation, equity compensation to the bondholders. The bondholders will agree to do that because they're going, look, if the company doesn't do well, we've got a preference on liquidation. We're going to get our 5% back plus our money. And if the company does really well, we're going to convert this to common stock. We're going to make a lot more money. And so convertible features tend to be found in rapidly growing or turnaround type situations where the bondholders go, okay, if this really works, we want a piece of the action on the upside. And if it doesn't work, we want to at least be able to be protected on the downside because we've got a liquidation preference. The other thing is this only goes one way and one time. So when you make the determination to convert your bonds into equity, you can't change your mind and go back. It's a one-way door. And so the benefit to that is you don't have your capital structure shifting back and forth between equity and debt all the time. Essentially, you go, okay, if you're going to convert to equity, you're giving up your bonds, you're getting stock, and you're gone. So you can't generally convert back from stock into a debt because you're moving up the capital structure as opposed to down the capital structure. And if you think about that waterfall that I talked about on how money gets distributed, that's where I start talking up and down the top of that waterfall. Once you go down, you can't crawl back up. And so this is one way down the waterfall. I'm only going to touch on this briefly. Foreign debt is debt that's denominated in the currency of the country in which it's sold. So if you buy bonds denominated in British pound sterling, that's foreign debt. Euro debt, that's sold in the country other than the one in which its currency is denominated. So if you sell if you sell a bond that's in pound sterling and it's sold into the UK, but the company is out of Switzerland, Novartis, let's say, which is a pharmaceutical company. The company is a Swiss company. It's selling debt in the UK, denominated in pound sterling. That's going to be euro. You're not going to run into that as a practical matter too often in this class or in reality. Let's talk a little bit about bond ratings. Bond ratings are essentially, you've got a couple of these folks, Moody's and S&P. And then there's a few others that are kind of specialty folks that take a look at bonds, take a look at corporate balance sheets, take a look at industry analysis, and essentially put a credit score against each company. And so similar to when you go out and you go, okay, I'm going to borrow money for my new car, and you've got a FICO score. Anybody here ever heard of a FICO score? Or an Equifax or TransUnion score, where they go on a scale of 1 to 800, where 1 is, oh my God, you probably wouldn't repay your mother if she was starving, to 800, which is, you'll repay everything all the time. The banks go and look at that and go, okay, we can't do all this analysis ourselves. We're going to hoover up all this data around who you borrow from, what your repayment history is, what your income history is, everything we can find publicly available, and it's reported to us by other creditors. We're going to take that information, we're going to put it into an algorithm, we're going to come up with a score that predicts your probability of default, and that's going to be your FICO score from 0 to 800. They do the same thing for bonds. Matter of fact, this is a lot easier than FICO scores, because FICO scores, it's a large population, we got to hoover up a bunch of data, and it tends to be somewhat imperfect. When you look at bond ratings, we tend to be able to pull out this publicly available information on companies and be able to go, okay, what's the probability that this company is going to continue to be able to repay their bills or continue to be able to pay off these bonds? And it's looked at in a couple different dimensions. So I'll walk through, you'll see that Moody's and S&P have essentially a parallel structure of A's, B's, and C's, and D's, D for default, by the way. That's what you'll find out at the S&P side. But generally, you're not going to see a lot of difference between a Moody's rating and an S&P rating because they rely a lot on the same information. High quality, investment grade bonds are ones that there's a very low probability of default within the next year. AAA bonds from companies and organizations never going to default. And then it ranges all the way down to default grade bonds, where you're essentially waiting for the company to liquidate and you hope you're going to end up getting some money back. The reason that this is at all important is twofold. First off, when you leave here and you become wealthy investors, you don't need to do all the mechanical analysis to try to figure out the credit quality of these individual bonds. You can, and that would be really cool. But you can also look up the Moody's and S&P score on each bond. And I'll tell you, if you got a mortgage bond issued by IBM, it may rate AAA. If you have a junior subordinated debenture from IBM, it may rate an A. So this isn't just the rating for the company. This is a rating for the combination of the company's ability to repay crossed with the bond indenture and the terms under which that bond has been issued. And so if it's a subordinated debenture and you're down the waterfall, your rating could be lower, will be lower than if you're at the top of the waterfall and you're fully secured. And so when you're looking, yes, sir.
I don't know if people like it, but I don't know if it's true or not, but wasn't it like a big thing like the other day that they were saying that like the ratings weren't accurate or something?
Yes. So that's what he said usually. So here's what happened. You get me all excited. So here's two things. I'll finish. I'm going to hit your comment, but let me finish where I was headed. So there's some requirements for banks and other financial institutions that they can't invest in anything that's rated BA or BB or lower. And so some banks, financial institutions, not-for-profits like our endowment restricts our ability to be in junk bonds. And so you need to have an investment grade. What ended up happening in the 2008 financial crisis was they took a look, and this is the downside. So all the quant method stuff you study, all the cool data science things that you learn, 2008 was like the exception to the rule. they looked at decades worth of mortgage bonds and mortgage securities and said, you know what, these things will never all default. And so we're going to build this mortgage security, which has AAA all the way down to BB, and we're going to layer it. And then we're going to issue it in the market. We're going to pay it off, starting with the A's first, and then we're going to ladder it down. And that was a collateralized mortgage obligation. The top of the analysis was pretty accurate. The first dollars in, we're going to get paid. Folks tended not to default on mortgages within the first year. And so that first tranche is what they call it, that first tranche of payments tended to get paid on time. What they failed to understand, however, is when the economy crashes and it does, and when real estate prices go down, which they do, and they have a couple times in history, that the bottom of that, where they said, oh, it's A grade because, you know, it's backed by a house. That house may not have been much of a house at all, and I can give an example from my own life. And it actually should have been down here. So one of the things I got to do in 2008, I think I might have told you this, was I was working with a private equity firm out of Dallas, and they acquired a company called Credit and Home Lenders out in San Diego, California. Now the cool part of working for Credit and Home Lenders was it was in San Diego, California. The downside was we went into the 2008 financial crisis, and we had all these mortgages, and one, you couldn't securitize loans anymore because the markets had frozen, and two, the collateral was junk. And so the ability to effectively rate these bonds was driven not only by the propensity of the underlying borrower to repay, but also the security interest. Remember I said, you know, if it's a fully securitized mortgage bond from IBM, it could be up here AAA, and a subordinated venture may be A for IBM. What we ran into, and this is a no BS example, was we had a mortgage in California, and I was the CFO of the company. We had a mortgage, and I would put in as the markets crashed, which was really fun. We started doing okay. We got these houses because the market's kind of held in a handbasket. We can't get the loans off our lines. We can't securitize. We got to start using cash. So we started foreclosing on the houses. The one house we had, we looked at the appraisal, and it said it was a 2-bedroom house with a pool in California, outside outside Palm Desert in Imperial County, and it was worth $400,000. When our guy went out to look at it, it was a shed with like a power pole that was sitting outside that ran an extension cord from the power pole to the shed. The pool was like an open ground pit that was full of rainwater, and the thing was probably worth $125,000. But the appraiser who went out there didn't care, and they got paid to make sure the loans got closed because they were getting referrals for appraisals from the loan brokers, and real estate never goes down. So this thing, it might have been worth $125,000, and it was basically the value of the land. It was appraised as a 2-bedroom house. Well, it was a freaking shed with no bathroom that was plugged into a power pole with an extension cord and an open pit with like water in it, and that was a pool. And so part of the challenge that we ran into in the 2008 financial crisis was not only did we fail to recognize that folks can, in a major financial crisis, in default on reports. Everybody goes, oh, we'll never lose our house. Yeah, people do lose their house. And we didn't put the probability high enough. The other thing we failed to do was really ensure that the collateral was a collateral. And so you ended up with something, you loaned $400,000, you get something that's worth $100,000. You're not secure at all, or at least you're undersecured relative to the amount of money that you got. So all of a sudden you got a $300,000 right. So that's what happened, and part of what happened in 2008 was a combination of not understanding the probability of default on mortgage bonds in an extreme economic situation, coupled with an incentive prior to the 2008 financial crisis to overstate collateral values in order to be able to get loans made, because mortgage brokers, appraisers, and others were paid by the loans that they generated. And so my time at Credit and Home Lenders was mercifully short before I was brought back here to run a company. that I had been the CFO at before, but accredited, ended up filing for Chapter 11 bankruptcy after losing nearly $500,000. And I was there for 6 months of that and kind of could see the writing on the wall. And so this was a major issue in 2008, and continues to be a major issue. When it comes to bond ratings, like I said, it's cool if you could do the work on your own. They tend to have gotten better with some time, but there's always going to be some question as to how accurate they are and how quickly they're updated. We kind of touched on some of these things. Financial strength, this is what goes into a bond rating. Financial strength of the company, whether it's likely to repay or not. The collateral provisions. So we, just in talking about some of these mortgages, we've touched on it. The collateral is critically important. If the collateral isn't there, or if it's unsecured, it's going to be lower. The seniority of the debt, where it falls on the waterfall, the higher up it is, the higher the rating. Restrictive covenants. Restrictive covenants could be things like, you can't sell this building, or you cannot enter into a different line of business, or you cannot divest something as long as these bonds are outstanding. It may also be that you need to have certain cash flow coverage, or you need to meet certain requirements as it pertains to reserves. Sinking fund or deferred call. Regulation and litigation. Companies will end up running themselves into trouble, either through regulation, we talked about this as it pertained to SEC early in the semester, or litigation, where all of a sudden you've got a situation, and I'll use the example of companies that used to do asbestos. So Johns Manville was a major company, extraordinarily successful. If you looked at everything above this line, they were a really successful business. Actually, I'll use a different one. I'll use U.S. Tobacco, because U.S. Tobacco built the O'Grady Library and built a good chunk of the Worthington Center. Tom O'Grady, who was the benefactor and gave the library, was the executive vice president of U.S. Tobacco. He made really good money. Died of cancer. So the U.S. Tobacco was impacted by litigation. State of Washington received billions of dollars from companies like U.S. Tobacco, Philip Morris, and others, because there was litigation that hit. Everything here looked really good. The companies were making money hand over fist until they got really hid the health effects of smoking and didn't disclose it when they were told they were supposed to disclose it. So they ended up getting litigated out of business, or litigated into the point where their bonds became much less financially viable, because they had a call on cash that went above the bonds. So litigation possibilities and regulation. If you begin to regulate something out of existence, whether that's certain types of mortgages, whether that's certain types of alcohol or tobacco, it can have impact on the company's ability to repay over time. Any questions on that? How many of you knew that the O'Grady Library was built with U.S. Tobacco? Oh, come on. You get more St. Martin's history in this class than you're going to get in any other class. This is the last slide I'll cover today. This is yields on long-term bonds. We've looked at this in a couple different dimensions as we look at the impacts of long-term and short-term interest rates. What can you generally, when you look at this, start telling me what story this chart is telling? You got a couple things. A narrow spread, a wide spread. You've got longitudinal data where you're seeing things sloping down and to the right. And then this is your corporate AAA bonds, which are, when we get to bond ratings, are pretty good. U.S. governments, which are considered default risk-free, and corporate BBB, which tend to be kind of pushing to that junk bond level. Tell me what you see in this chart. I'll give you a breadcrumb. What do you see in 2008, where it says widespread? What is that telling you? What's the market telling you?
That it was really good until the sugar high came off.
It was good until the sugar high came off. What happened in 2008? Highest and lowest. Here's what you saw in 2008. This is a classic flight to quality, where folks go, crap, the economy's going to hell in a handbasket. I want to make sure I'm going to get repaid. I'm going to start buying U.S. government bonds. When you start buying a bunch of U.S. government bonds, demand goes up, supply is flat, therefore prices go up, and therefore interest rates go down. Triple B corporate bonds, things are right on the edge of junk. All of a sudden they're going, okay, default risk premium starts to rise. I'm going to have lower demand, prices go down, interest rates rise. You can actually see in this 2008 time where interest rates can both fall and rise at the same time, driven by impacts to things like default risk premium and liquidity risk premium. And so when you see flight to quality here, this is, and again, these things tend to start right in 2008. And you're talking early 2007, we saw this on the other graph. The market starts telegraphing what's going to happen in the economy normally before we figure it out. Normally before it hits the paper or CNN. When you see a narrow spread here, 1995, that was the middle of one of the longest expansions in U.S. history, coming off the 1991-1995 recession. Everybody was kind of fat, dumb, and happy. Yes, sir.
And since AAA take into account who gets paid for this, that one is stayed well.
Right, because AAA takes into account both probability of default as well as those other components, including security and collateral. AAA didn't really change much in 2008 relative to where it had been all the way back to 2006. What we also saw, and you saw this on the other long-term interest rate graph, is long-term rates over time that continue to fall. So we're seeing historically low long-term rates and have continued to see that going out into 2017, 2018. Any questions on this stuff? Like I said, I've opened up the midterm. Feel free to get started on it. If you run into any problems, let me know. It's lengthy. We're going to continue to blast your body. Math is far less important than understanding the theory behind it.